Imagine waking up each month and seeing $12,000 deposited into your account from a smart investment portfolio. It's important to recognize how much has changed in the investment world. Last month, one investor faced a harsh truth. They missed $175,000 in growth. Following the old advice that worked in the 90s isn't enough anymore. The market is globalized and yields are lower. Why keep money in strategies designed for dial-up internet when today's economy streams in 4K? Sticking to the old path could mean waving goodbye to hundreds of thousands in future earnings. Picture putting aside $500 each month for 20 years. Under conventional plans, that grows to about $250,000. Not bad. Now think about that same investment turbocharged by updated ETF categories, backed by years of research. Suddenly, that stack could soar to nearly $500,000. Double the magic, double the possibilities. The difference comes down to compound interest working for you instead of against you, fueled by returns in endless cycles. But what does it actually take to hit $12,000 every single month? Enough to walk away from a job and live comfortably? Let's break it down together. Every sturdy house sits on a strong foundation. The S&P 500 index is that unshakable bedrock for an investor's future. This isn't a get-rich-quick product. It's the sleep well at night core. Over any 20-year period in recorded history, an investor holding this index has never lost money. The S&P 500 brings a dependable consistency, delivering positive returns 74% of the time in a single year, rising to 83% for 5 years, and an incredible 92% for 10-year stretches. Long-term investors, even during the worst storms, have always come out ahead. There's calm in knowing that these ETFs, VU and VTI, are quietly adapting with the market. VUO focuses on America's 500 largest companies. VTI adds mid-size and smaller business exposure for extra growth. Either choice means extremely low fees, just $3 a year for every $10,000 invested. The only decision is whether stable giants or broader market diversity feel right. Holding these foundation ETFs automatically upgrades the portfolio as new innovators rise and laggards fade, without the need to make a single trade. When thinking about long-term safety and worry-free sleep, nothing comes close. The performance history tells a story of resilience and opportunity. Every year brings a fresh crop of innovators into the index, ensuring exposure to technological change. Big names like NVIDIA, Microsoft, and Apple aren't just filling headlines. They're forming the core of these funds. Even during rocky years, diversified holdings cushion the impact, spreading risk across sectors. VOO and VTI have averaged annualized returns above 13%, outpacing inflation and rival strategies. These ETFs also bring healthy dividend yields, enhancing growth through compounding. Fees stay rock bottom, making this approach cost-effective without sacrificing quality. Portfolios built on VOO or VTI lean on consistent performance and transparent methodologies. When considering how to weather the next 20 years, few tools offer reliable peace of mind like these market leaders. Tradition calls for bonds to create safety. But let's get candid. Bonds are now a leaky bucket, offering only 1.6% returns. That familiar safe investment has shifted into something quietly eroding wealth instead of growing it. Popular bond ETFs deliver underwhelming results. $50,000 invested becomes just $58,000 after 10 years. It's time to rethink our strategies. Enter the modern hero, dividend-focused ETFs. The Schwab US Dividend Equity ETF, or SCHD, flips the script. CHD carries high-performing, cash-flow-strong companies like Coca-Cola, Chevron, and Home Depot, thriving through challenges. CHD has delivered an average of 11.5% annual returns for the past decade, with a dividend yield close to 3.5%. A $50,000 investment in SCHD grows to about $150,000 over 10 years, providing nearly $92,000 in extra gains compared to bonds. Those dividends tend to grow over time, keeping pace with inflation and maintaining purchasing power year after year. Giant companies in SCHD have survived every economic cycle, delivering both growth and safety. Specialty income ETFs like JEPI and JETQ offer yields as high as 9 to 11%, making $12,000 per month an achievable goal. Is international diversification a must-have, or is it draining wealth? The answer has changed. Globalization means American companies now lead on every continent. Apple and Microsoft earn billions from Europe and China. Reality check. International-focused ETFs have returned just 4.6% a year over the last decade, while growth-oriented tech ETFs like QQQ and QQQM rocket ahead, delivering up to 18.36% per year. U.S. tech and innovation companies form the engine of global growth and dominate the new interconnected world. Investing in growth ETFs centered around these companies means capturing the upside of digital transformation, artificial intelligence, and cloud computing. QQQ and QQQM feature stars like Google, Tesla, NVIDIA, and Meta, giving every investor a front-row seat to explosive progress. Swapping old-school international stocks for growth ETFs is like trading a faded map for cutting-edge GPS navigation. Wealth creation becomes faster, steadier, and more resilient to regional downturns. Growth ETFs upgrade international exposure by investing in global powerhouses underpinned by American standards. American companies are influencing energy, tech, and consumer trends globally, turning local innovation into worldwide impact. With a single purchase of a growth ETF like QQQ, investors can ride the wave of global progress without multiple funds. Transparency in holdings allows investors to see exactly where their money is working, boosting long-term confidence. Growth ETFs have consistently shown the ability to bounce back from downturns, often outperforming broader benchmarks. Investors who track quarterly updates and industry shifts refine their growth ETF allocations for lasting results. Leaning into innovation means investing in strategies that build toward tomorrow, not just preserve yesterday's gains. Earning $12,000 per month through ETFs requires math, discipline, and strategic allocation. It's not magic. High-yield dividend ETFs like SCHD, JEPI, and others yield between 3.5% and 11%. Selection affects your capital needs. With 4% yields, to earn $144,000 annually, you need to invest $3.6 million. Explore aggressive options for reduced capital needs. More aggressive ETFs offering 8 to 11% yields lower the entry point to around $1.5 million. but consider additional risks involved. Some ETFs, like MSTY, promise rates topping 143%. $100,000 invested could generate $12,000 a month, though risks exist. Smart investors check sustainability and reliability and avoid dividend traps, where value may erode despite high payouts. Moderation, research, and review of holdings keep your monthly income steady and resilient. Reliable high-yield ETFs, S&P 500 index funds, and tech giants ensure both security and growth. Regularly review fund performance and spot trends before they impact payouts. Market conditions change. Adjust your strategy for the next year to maintain steady income. Factor in inflation. Yields must keep pace with spending power over time. Transparency in ETF holdings shields against surprises in your income stream. Strategic tax planning ensures more cash stays in your pocket from high-yield distributions. Use automated tools like calculators and simulators to visualize income strategies. Diversify within categories, avoid over-concentration, and shift holdings if needed. Stay updated with ETF newsletters for news on index changes and new opportunities. Adapt strategies based on life stages, transforming passive investing into a journey. With discipline, research, and flexibility, reaching $12,000 a month becomes an achievable goal. The best results come from thoughtful allocation. For those in their 20s, time is a huge ally. Funneling 50% into growth ETFs like QQQ, 40% into foundation ETFs, VU, VTI, and 10% into income ETFs like SCHD maximizes upside over decades. In the 40s, shifting to 40% S&P 500, 30% SCHD, and 30% QQQ balances growth with stable earnings, helping raise teenagers and plan for retirement. As retirement nears in the 50s and beyond, safety and income take center stage with 50% income ETFs, 30% foundation, and 20% growth. No need to overhaul the portfolio every 5 years. Just adjust the sails as life changes, keeping the same strong ETF anchors in place. Simplicity leads to powerful flexibility. Consistency matters more than perfect timing. Regular monthly investments take advantage of market dips and keep risk low through dollar-cost averaging. Everything about this updated 3 ETF portfolio speaks to today's world: adaptability, global reach, and resilience. Old strategies aren't keeping up, but these ETFs are engineered for today's fast-paced financial landscape. The barriers to monthly income are lower than ever for those willing to modernize. The 3 ETF strategy delivers compound results without complex hassle. That $12,000 a month could be just the first step to a wealthier, more empowered life. Ready to upgrade that portfolio and start living on your own terms? Be sure to subscribe for more insights, share your thoughts in the comments, and hit that like button.